finally found a broker on Wall Street that you can trust, and who can consistently make you money. Sound fair enough?
When people start to think about investing, the first thing that comes into their minds are stocks and stockbrokers. The idea of investing a chunk of your life savings into the shares of a single company is quite daunting. How can you know that the company that you've chosen is the right one? Well, luckily there is an alternative. Hello and welcome to my video. My name is Ash. I work at a wealth management firm in London where I'm currently studying to become a financial advisor. My goal is to educate people on personal finance and investing, so I'd really appreciate it if you could like this video and subscribe to my channel to help push out my content to as many people as possible. Although I am training to become a financial advisor, my content does not constitute financial advice. Investing in stocks is a common method for growing your wealth. But if you're new to investing with little knowledge of the markets, it can be difficult to make the right choice.
Hey, why are you buying that? The CEO was just indicted.
But not for the big fat defense contract he bribed his way into. That's still on.
So first of all, what is a stock? Well, when you invest in a stock, you're purchasing the shares of a company. Whereas when you buy a fund, you're investing into a collection of stocks, which is chosen and run by a fund manager and a team of analysts who are trying to achieve a specific objective. So what is a fund? A fund is an easy and convenient way to get started with investing. They offer diversification and professional management, so investors like us don't need to spend hours researching companies. An example from my personal portfolio could be the Baillie Gifford American Fund, who specialize in the top companies in the US. So by investing with them, you get exposure to companies like Tesla and Amazon. Funds can be invested in a number of different types of asset, such as shares, bonds, gilts, and even property. Some funds aim to specialize in a specific type of asset, whereas others aim to mix between them to create a diversified portfolio. A lot of funds offer two types. One ends in the letters ACC and the other ends in the letters INC. These refer to accumulation and income respectively, which relates to how income payments for your investments will be treated, such as dividend payments and distributions. When you own shares of a company, you are effectively a shareholder, which means that you're entitled to the profits that a company generates. These profits are paid out via dividends. Income funds make dividend payments directly into your account. Then you choose what to do with it. So you can either invest it into something, or you can take it out as a withdrawal. Whereas accumulation funds automatically reinvest all dividend payments directly back into the fund that they came out from. This means that accumulation funds tend to be better for long-term investors, and income funds tend to be better for short-term investors who like to make a lot of changes to their portfolio. Actively managed funds are run by a fund manager and a team of analysts who choose the fund's investments and make changes on a regular basis. These funds look to outperform the stock market, but of course there are no guarantees. Passively managed funds, otherwise known as tracker funds or index funds, try to track a market instead of trying to outperform it. The performance of these funds is tied to the ups and downs of the market that they're trying to track. For example, a passive UK fund would track an index such as the FTSE 100. Both types have their advantages. However, passive funds tend to be much cheaper due to the lack of active research and management. There is no research to prove that either type is better in the long term, so if you're building a portfolio, it might be worth including both types. Individual stocks can be traded at any time as long as the market is open. However, funds can only be traded at 1 or 2 dealing points per day. This is usually around midday, so it's likely that an instruction made after midday would only be actioned the next day, which means the price could change from when the instruction was made. When investing in a fund, you have to pay an ongoing fee to the company that's managing the fund. This is expressed as a percentage of the amount that you have invested in the particular fund and is calculated daily. These fees aren't taken out of your cash account like normal platform fees. Instead, fund managers adjust the price of your holdings to take into account any charges. Overall, funds allow me to create an investment portfolio which is diversified across all major economies without having to spend hours doing research on individual companies. My personal portfolio is invested in 14 funds. However, each fund is invested in roughly 10 to 15 stocks, meaning I have exposure to over 200 individual stocks. If you want to learn more about funds and investing in general, please check out the Wealthy Minds newsletter by heading to my website at wealthymindofash.com. Finally, thank you for watching. If there are any parts of this video that you'd like me to go into more detail on, or if you have any questions, please leave them in the comment. I'd also really appreciate it if you could give this video a like to help push out my content to as many people as possible. And if you'd like to see more of my content, please go ahead and subscribe.